How's it going, everyone? My name is Amos, and welcome back to the Dividend Compounder Show. If you're anything like me, then you're probably a fan of passive income, in that you can make money while you binge watch Squid Games on Netflix or just sleeping. Which, by the way, if you have not watched Squid Games yet, it is definitely worth the watch. Anyways, my preferred passive income method is dividend investing. So with that, in this video, we are going to review 20 companies that just increased their dividend payout. But first, why is this video even important? To answer that, I follow two different investing principles. One is value investing, buying high-quality companies at a good price. And the other is listening to your wife's boyfriend about stocks. I'm just kidding. The second is dividend growth investing, buying into dividend compounders that grow my initial investment in them from their stock price and increasing dividends. To me, I think it's crucial that we as investors pay attention to dividend growth, because it's the dividend growth that allows the dividend yield to keep up with its stock price growth. Because think about it. If the stock price grows, but not the dividend, then the dividend yield is going to be insignificant in a matter of years. But that's not the case with dividend growing companies. Because if a company is running and is sailing a clean ship with even better operations, then their stock price will appreciate and the dividend payment should grow year over year. So think of it as two balls in one sack. That's why I like dividend compounders. Your money will compound through two different avenues. Alright, so you're telling me you're still not convinced about dividend growth companies being attractive. Well, I think S&P Global says it best. Check this out. So this is a research paper published by the S&P Global. If I scroll down to right here, why dividend growers? Well, dividend growers tend to be high quality, provide better returns, and they even make your small PP a little bit bigger. And I'll go ahead and put the link to this document down in the video description. And if you prefer a video format, I'll also leave that link next to this one as well. So if you don't get it by now, dividend growth companies tend to be some of the best investments available on the stock market. So with that, here are the companies that have just increased their dividend payments in the last few weeks or so. There's 20 of them. So go ahead and sit back, take your pants off if you prefer to be more comfortable, and we're going to look at each one individually. Here we go. But before we do, yesterday, my Tottenham Hotspurs played against Tamworth in the FA Cup tournament. Apparently, half of the guys on the Tamworth team have day jobs, such as being plumbers, and even as a Zara retail worker. You would think a Premier League team playing against a 5th Division team would be a landslide victory. It's kind of like the Golden State Warriors playing against your rec league team after a gym workout, and then those guys hanging in there and giving the Warriors a run for their money. Because let me tell you this, the final score after 90 minutes was 0-0. I am not exaggerating. I mean, Tamworth did play defensive football, but it was shocking that it wasn't until the extra time, in overtime, that we won the game 3-0. But I think that's one of the beauties of the FA Cup, because you'll have these world-class teams playing against some of the lower division teams sprinkled throughout England, and I think it's a magical moment. Regardless, a win is a win. I'm sure you don't care about football, so let's go ahead and take a look at the first company. So the first one is going to be ABM. Their bread and butter is their janitorial services for corporate companies. But ABM also provides parking and transportation services, HVAC services, and they even do landscaping. You can think of them as a do-it-all support company to help other businesses run smoothly and for their properties to look clean. So their current dividend yield is 2.1%, which means for every share of ABM that you own at about $50 a share, you get $1.06 in dividends. They've been growing their dividend for 59 years, which, if we're going to be honest with one another, that's probably older than you are. So they're growing their dividend longer than you've been alive. And for the past 3 years, they're growing their dividend at a rate of 5.8% year over year. That means this number right here is growing 5.8% year over year on average. So how exactly did their dividend recently grow? Well, it went from 23 cents a quarter, or every 3 months, to now it's going to be 27 cents every quarter, which is fine and dandy, but what I do want to call out is that their dividend payout ratio is a little high. It's 83.4%. And yes, like ABM is a very mature company, but for their payout ratio to be this high, makes me a little uncomfortable. So the bottom line when it comes to ABM, good company, but it's a pass for me. I'm not really interested in them. The next company is going to be Abbott Laboratories, ticker symbol ABT. This is a pharmaceutical company that makes prescription and over-the-counter drugs. And their current dividend yield is 2.1%. Annual dividend payout is $2.36. They've been growing their dividend for 54 years. My goodness, that is beautiful. And they've been growing it in the past 3 years at a rate of 6.9%, meaning this number grows 6.9% year over year. The only thing that I don't agree with is they have this labeled as red, being as a little too high, but I think that's fine. For a very mature pharmaceutical company, I think anything less than 75% should not be red or even yellow. So in my opinion, I think their dividend is safe, sustainable, and there's a lot more room for growth, meaning that Abbott can keep growing their dividend at a rate of 6.9% and not run into too many problems. Their dividend went from 55 cents every quarter to now it's going to be 59 cents a quarter as of February the 14th. And when it comes to Abbott, I think they are fairly valued at about $110 to $115 a share. And unlike their peers in the pharma space that are getting really beaten up, Abbott is doing just fine. However, I still don't want to touch them because there are better opportunities in the market. And you probably have not watched my video about why I don't invest into pharma companies. So go ahead, get up to speed, watch that video so you can see eye to eye with me, or nipple to nipple, whatever floats your boat. The next company is Amgen. This is a biotech pharmaceutical company with a portfolio of drugs that will make your head spin. Right now, they're currently trading for about $260 a share. The dividend yield, I think, is pretty decent, 3.6%. Meaning, every share of Amgen that you own, you get paid $9.52 a year in dividends. I think that's pretty respectable with a capital R. They've been growing the dividend for the past 14 years at a rate of 8.5%. This number grows 8.5% year over year. But the red flag here, friends and family, the dividend is not sustainable, nor is it healthy because the payout ratio is 121%, meaning Amgen is collecting more cash to pay out the dividend than they have cash on hand. This is not a good situation. Unless Amgen figures out a way to increase their net income so that their dividend payout ratio comes back down to earth. At 121%, I don't know how much longer this dividend is going to be safe or sustainable. With that said, their dividend payment is going from $2.25 every 3 months to now $2.38. But if they stay at a triple-digit rate for like 2 years or even 3 years, they're definitely going to have to cut the dividend because in order to sustain that dividend, they're going to take out loans and tackle on debt so that the shareholders can get their dividends. But they're probably just going to cut the dividend and not get to that point. Needless to say, when it comes to Amgen, I think on surface level, they do look slightly undervalued. But then again, when I take a look at their dividend payment situation right here, their net income is not looking too bright. And it's a pharmaceutical company, so I'm not interested. Let's go ahead and move on to the next company. The next company is Broadcom, ticker symbol AVGO. This is a company that is hot right now because of the AI chips race. Basically, they make chips for phones, laptops, and now data centers. Their payout ratio is 44.7%, meaning their 1% dividend is absolutely sustainable. It's not the juiciest, it's 1%. It's nothing to write home about. But for every share of Broadcom that you own at about $220 a share, you get paid $2.36 a year in dividends. And they've been growing this number at a rate of 14% year over year for the past 5 years, which I think is pretty good. So Broadcom is growing their dividend from 53 cents every quarter to now it's going to be 59 cents. And in terms of their valuation, it depends on who you ask. Some people would argue that Broadcom is undervalued because they're going to be a leader in the AI chip space for the next 3 to 5 years with making custom chips for Google, Microsoft, and whatnot. But other people like me, I think that Broadcom right now is overvalued for the time being. I think they are a company with a bright future, but at its current price, I don't know. It's a very high quality company, don't get me wrong, but I wouldn't buy into them at their current price. Does that make sense? The next company is Bristol Myers Squibb, ticker symbol BMY. Their current dividend yield is 4.4%, which is pretty good. I think that's pretty juicy. Meaning for every share of Bristol Myers that you own, you get paid $2.48 a year in dividends. Is it sustainable? Absolutely not. The dividend payout ratio is a very big red flag. A red flag like eating street food in India. This is no bueno. This dividend is not going to last that much longer. But anyways, they've been growing it at a rate of 7.5% year over year for the past 5 years, which I think is pretty respectable. And when you look at it visually, it goes from 60 cents a quarter to now it's going to be 62 cents. Now, Bristol Myers is trading for a small discount to their intrinsic valuation of about $60 a share, because right now they're like $55, $56 a share, but it's going to be a pass for me. I don't think their dividend is going to be sustainable, and they also operate in the pharmaceutical industry. My bad for not giving an introduction to the company. They're also in the pharma space. The next one is the Campbell's Company, ticker symbol CPB. They're basically in the business of packaged foods, CPG products, and pasta sauce. They're currently trading for about $38 a share. When we look at their dividend profile, dividend yield is 4.1%, which I think is pretty juicy and it's good, meaning for every share of Campbell's that you have, you get paid $1.56 a year in dividends. Payout ratio is 48%. Super sustainable, very healthy. So far, so good. These are all green flags, but this is the first red flag. They're growing it at a rate of 1.3% year over year on average for the past 5 years. So this is only going to grow by 1.3%. Not that great. And when we look at it visually, Campbell's paid a dividend of 37 cents per quarter as of October 2024. Now it's going to be 39 cents every quarter. But remember, their dividend isn't really growing. I mean, 1.3% technically it is, but nothing to be too proud of. It's like the type of people who kiss their sister on the lips. Like, yes, it's a kiss, but it's still pretty gross, my friend. And when it comes to their current valuation, I think of it as a Black Friday, Cyber Monday type of discount on Campbell's. I think it's very undervalued and it's pretty attractive. However, I would rather dollar cost average and continue to buy PepsiCo instead. So for me, it's a pass, but I can totally see why someone would want to buy shares of Campbell right now. The next one is going to be a REIT known as CubeSmart. Basically, they're in the business of storage units. When people have too much junk and crap in their house, that they go out and they rent a little shed that they can put all of their crap into. And as of right now, Cube is currently trading for around $40 a share. Their dividend yield is around 5.1%, which I think is pretty impressive. And when we look at their adjusted funds from operations to dividend payout ratio, then it's a 78.5%, which means the dividend is sustainable and it's healthy and there's room for more growth. When we talk about growth, they're growing their dividend at a rate of 2% year over year. So it's not the biggest growth, but at least it's a little better than Campbell's. All things considered, I think Cube has a juicy dividend yield and it's trading at a small discount, but it's in the REIT industry. So I would rather just buy into Realty Income Corporation or even Crown Castle. With that, if you buy into CubeSmart or if you are a current shareholder of Cube, it makes sense. I wouldn't blame you. The next one is going to be the John Deere Company, ticker symbol DE. They basically manufacture and sell farming equipment, machinery, tools to the farmers. Their current dividend yield is 1.6%. We'll just round up and give it to them. Currently trading for about $400 a share. $400. My goodness, that's very expensive. The annual dividend payout is $6.48 per share that you own. The dividend payout ratio, really sustainable, very healthy, 22%. And they've been growing it at a rate of 14.6% year over year. This number right here is growing at a very aggressive rate that you love to see because the payout ratio is really low. It's sustainable. They can afford to do so. And when we look at it visually, their dividend is basically going from $1.47 a quarter to now it's going to be $1.62. Now, don't call me a racist, but I think this one is just way too expensive for what they are currently trading for. If I was a current shareholder, I would be happy. I would hold on to them. But I would never consider buying in terms of opening up a brand new position into them. They're just too expensive for their business and their sector and for what they do. No, sir, I'll pass. But even though I'm choosing to pass, I think their dividend profile is just really beautiful. It's almost perfect. If the dividend yield was a little bit higher, around like 2.5%, and the payout, everything remains the same in the growth, I would say it's the perfect example of a dividend compounder with cheese. But because the dividend yield is a little lower, I can't give them that title. Let's move on to the next company. The next one is Ecolab, ticker symbol ECL. They're in the business of sanitation and water treatment. And to expand on their business model, when you think of soap in a corporate building's bathroom, pest management in and around the shopping mall that you visit, and they even do disinfection for pharma manufacturing to make sure that the overpriced drugs are being produced the right way and in a clean way. Well, anyways, they're currently trading for about $230 a share. Let's go ahead and round up. Dividend yield is 1.1%, not too high, not the prettiest thing in the world, but we'll give it to them. The annual payout is $2.60. The payout ratio, absolutely sustainable and healthy. You love to see it, 35%. And their 5-year growth rate, they're growing this number by 5% year over year, and they've been doing it for the past 32 years. When we look at it visually, their dividend payment every quarter is going from 57 cents every 3 months to now 65 cents. When it comes to Ecolabs, I think it's a great company, and I would love to have Ecolab be a part of my portfolio. However, as of right now, I think they're slightly overvalued. And depending on the day, I would even say fairly valued. For what they do, $229, it's a good price. And I'll say this, they have been on my watch list for almost 4 years now, and I still haven't pulled the trigger. The next one is Lamb Weston, ticker symbol LW. They're basically in the business of selling frozen potato products to hotels, restaurants, and to different grocery stores and vendors. So when you eat French fries or tater tots at a restaurant, they're most likely procured and produced by Lamb Weston. That's their business model. And they're currently trading for about $60 a share. Dividend yield is 2.4%. Payout is $1.48. Payout ratio, I think, is pretty good, 42%. And they've been growing their dividend at a rate of 12.5% year over year for the past 5 years. I think that's really delicious. And when we look at their dividend visually, it's going to go from 36 cents every 3 months to now 37 cents every 3 months. And just like some of the other food and CPG companies, they are undervalued, but their business model just does not interest me. I don't really get a fuzzy feeling in my stomach about this company. I think they're very boring and they're stable, but I don't know, it just doesn't interest me. Let's move on to the next company. The next one is Mastercard, ticker symbol MA, currently trading for about $500 a share. When we take a look at their dividend profile, by the way, I don't have the premium access for Seeking Alpha, and that's why it says, hey, subscribe now, but we'll work with what we got. Their dividend yield, my goodness, 0.6%, not juicy. However, let's see if the rest of their dividend profile checks out. Payout is $3.04 a year. I think that's pretty good. Payout ratio, really good, 18.9%. They're growing it at a rate of 14.5%. So what I think is because this payout ratio is so low and the dividend yield is so low, I think they can even bump this up to like a 17 or even like a 20% growth for this number right here. They can afford to grow the dividend at a more aggressive rate. Isn't that weird? I'm being picky knowing that their growth rate is 14.5% because I know they can afford to do so. But anyways, if you don't know what business Mastercard is in, they're in the payment processing space. So every single time you swipe your card at a vendor or when you shop online, that establishment has to pay a fee to Mastercard in order to process your payment. So Mastercard is a very good example of a toll booth and a very incredible economic moat type of company. Visually, let's look at their dividend going from 66 cents every 3 months to now it's going to be 76 cents, which I think that's a pretty modest growth of that dividend. My goodness gracious. Now, with all that said, we can agree that Mastercard is high quality and they are a very good compounder. However, they are too expensive right now. So for me, it's going to be a pass. And when I think about Mastercard, I think it's a buy on the dip kind of business. And I say that because if I were to buy shares of Mastercard right now, I think I would be overpaying for it. At its current valuation and forward trading multiple of a 35, I just can't. The next company is McCormick. They're in the business of spices, hot sauce, and seasoning for food. Yes, this is the parent company of Cholula hot sauce, which I think is probably one of the best hot sauces that you can buy at a big box store. Their dividend profile, let's take a look at it. $71 a share. Dividend yield is 2.5%. The payout is $1.80. The payout ratio 55%, which I think is pretty good. They're growing it at a very good rate of 8%, which is a lot higher than the rate of inflation valuation, and they've been growing their dividend for the past 38 years. So far, I would say everything about their dividend profile just looks really good. Their dividend visually is going to go from 42 cents every 3 months to now 45 cents every quarter. I think McCormick is operating in a very niche space of the food industry. I think their fundamentals and dividend profile look pretty good. However, when it comes to their valuation, I think they're fairly valued, and it's going to be a pass for me. I would rather buy into other companies that are operating in the food space than to buy into McCormick, if that makes sense. I mean, their trading multiple is a 24.5, whereas their peers are hovering around like 11 to like a 13. And remember, I'm a value investor, so I would rather buy into their peers that are beaten up than to buy into McCormick, who is currently, fairly valued, in my opinion. The next one is Morningstar. This is a very good resource and tool to do stock research. Their platform is one of the best out there, in my opinion. They're currently trading for about $315 a share. When we float on over to their dividend profile, their dividend yield is 0.5%, meaning for every share of Morningstar that you own, you get paid $1.80 a year in dividends. And they're growing their dividend at a rate of 8% year over year, and it looks like their payout ratio is missing right here, so let's investigate a little further. Morningstar's payout ratio is currently around 21.6%, and they're growing it for the past 14 years, so I would say their dividend profile checks out. It looks okay, and I say okay because the dividend yield at a 0.5%, I mean, come on. You get better returns from your bank account, for crying out loud. But anyways, the dividend is going from 41 cents every 3 months to now, as of January the 3rd, it's going up to 46 cents every quarter. So when I think about Morningstar, I think they're just a little too expensive for me at their current valuation. I mean, their trading multiple is a 40, for crying out loud. However, I do think that Morningstar is a very solid company. I would buy them at the right price, but anything above $300, I mean right now $315 is just absolutely a no from me. The next dividend grower is going to be the Mosaic company. Ticker symbol MOS, currently trading for just under $25 a share. They're in the business of selling fertilizers that you put into the soil for your crops and plants. I know. Not exactly the sexiest business model like Nvidia, but sometimes a boring business model that is stable and reliable is better than a flashy one that just goes bankrupt in a matter of years. Anyways, their dividend profile, a 3.5% dividend yield, I think that's pretty good. 88 cents a year in dividends, payout ratio checks out, green flag, very healthy, and they're growing it at a rate of 37% year over year for the past 5 years. That is ridiculous. We have to investigate a little further. I think that might be a glitch. My goodness. Upon further review, I don't think it's a glitch, but I think what happened is, which probably explains that crazy growth rate, because when we fast forward to the present tense, it's basically going from 21 cents every 3 months to now 22 cents, which makes more sense to me than to see a number like 35% growth rate. So I think it's a little misleading to assume that the dividend is growing, 36% every single year. I think it was just that one fluke of an year that throws all the numbers off. But with that said, I do think Mosaic is undervalued, but their business model and future, it looks pretty weak to me. So it's going to be a pass for me. I'm not interested in this company at all. The next one is going to be Nucor Corporation. They're basically in the business of steel and everything to do with it, the manufacturing of it, the production of it, and even turning that steel into something else so that you can use it. Their dividend profile, they're currently trading for about $118 a share. Dividend yield is 1.8%. Payout is $2.20. Payout ratio, very healthy and sustainable. And they're growing it at a modest rate of 6% year over year. And they've been growing their dividend for the past 51 years. Now we're talking, friends and family. I think that's a really solid dividend profile. When we take a look at this dividend growth visually, it's going from 54 cents every 3 months to now 55 cents. Yay, wow, an extra penny. But hey, that extra penny adds up, especially if you have a lot of shares of Nucor. Based on my limited understanding of the industry on the horizon, there's no doubt in my mind that I think the steel industry is undervalued. However, it's a sector that does not interest me too much. I think the business of raw materials has a place in people's portfolios, especially if you understand the landscape and the commodity prices fluctuating here and there, but I would rather just buy into the finished products. A company with a brand, the enterprise, the whatever it is, the medical equipment, home appliances, or even tools, the ones that use the steel that Nucor produces and turns it into something a consumer can use, because I just feel like that is a little more stable and reliable than the production of steel itself. Does that make sense? Now, I could absolutely be wrong, but that's just my opinion. The next dividend grower is going to be Owens Corning, ticker symbol OC. Owens Corning is in the business of home building materials and supplies, like the stuff that you put into the wall or the stuff that you put on the roof, anything to do with home building. And funny enough, one of my MBA classmates is a pretty high position finance person at Owens Corning, so I have a pretty high opinion of this company. Anyways, they're currently trading for about $167 a share. Dividend yield is 1.6%. Payout is $2.76. The payout ratio is really low. My goodness, they're being a little stingy. They can afford to pay a little more dividends. And yes, they are growing it at a rate of 22%. I guess they see eye to eye with me. And they've been growing it for the past 6 years. When we look at their dividend visually, it's going from 60 cents every 3 months to now 69 cents every quarter. I like what I see with Owens Corning. So what are my thoughts and opinions about this company? I think it's going to be very similar to Nucor Steel, as I think home building materials are on the dip because of the whole, recession fears that are coming up, and I'm just not going to be too interested in this one. I think it makes a lot of sense on paper, but I'm not fascinated with the idea of being a business owner of construction materials like insulation and roofing tiles. It's just not for me. I would rather buy into Home Depot or Lowe's. That's just me. The next dividend grower is Pfizer, ticker symbol PFE. This is a favorite among the dividend investing community. They're in the pharmaceutical industry and they have a lot of drugs in their portfolio. Their dividend profile, let's take a look at this. They're currently trading for about $26 a share. Dividend yield is 6.4%. Absolutely juicy for a company that is not a REIT. That's a really high payout. I respect it. Meaning for every share you own, you get $1.72. Payout ratio is a little high, but it's nothing too bad for a very mature company, 64%. Pfizer grows this number at a rate of 4.2% year over year, and they've been growing their dividend for the past 14 years. And when we look at their dividend growth visually, it's going from 42 cents every 3 months to now 43 cents every quarter. So on paper, I think Pfizer is absolutely undervalued. However, I would not invest into them. And before you think I'm being ridiculous passing up on all of these very juicy high-yield pharmaceutical companies, you gotta go ahead and give my opinion a listen. I made a dedicated video talking about why I avoid the pharma industry like a Jehovah's Witness and blood donation drives. I don't know if I already made a shout out to that video, but if you have not seen that video, you have to give it a watch. I promise it's gonna be insightful and you're gonna walk away learning a thing or two about the pharmaceutical industry because I worked in it. The next dividend grower is the Progressive Corporation. They're basically in the insurance industry. For homes, auto, life, whatever it is, they'll insure you. They're currently trading for about $235 a share. When we bounce over to their dividend profile, dividend yield is 2%, I think is okay. It's not the highest, it's not the lowest. Payout is $4.90. The payout ratio, friends and family, is a single digit of 8%. Why are they not paying more for their dividend? They're being stingy. They're growing it at a rate of 11% year over year. However, I'm going to warn you, this is very misleading because when we take a look at Progressive's dividend history, every 3 months or every quarter or so, they've been paying 10 cents. However, every so often in the winter month of like December or January, they do tend to bless the investors with like a surprise and special dividend that's astronomically higher than their usual payment. So instead of just getting 4 dividends in a year, with Progressive, you get 5. So in 2020, they gave a special dividend of $2.25 in the winter month of January the 8th. And in 2021, it was $4.50 alongside with the 10-cent dividend every 3 months. And then they did so well in 2021, they gave another special dividend in December of $1.50. And then in 2022, I guess operations weren't as hot. They just paid 10 cents every 3 months, no special dividend. Same story in 2023. And then in 2024, they paid paid a special dividend of 75 cents alongside with those 10-cent dividends. And then in 2025, they just paid a special dividend of $4.50 on top of the regular 10-cent dividend. So I don't think Progressive is growing their dividend. However, they are returning a lot of value back to the shareholders in the form of this special dividend. So instead of just doing share buybacks, they're giving a lot of their profits back to the shareholders through dividends. So when I think about their dividend profile and their dividend situation, I bless it. I think this is beautiful. I don't care that they're not growing their dividend every single year, because every so often you get a surprise dividend that's just crazy beautiful. What are my thoughts and opinions on this company? I think it's a beautiful stock market performer and they have excellent business fundamentals. I think I need to do a deep dive video for them in the future. However, I do think they're super expensive in my opinion as of right now. Progressive, I think it's one of those companies that you buy on the dip. But their dividend situation, although it's a little weird, I think it's absolutely delicious and beautiful, and I would just love to take it out on a date. The next dividend grower is Stryker Corporation. They're basically in the business of medical devices and medical equipment, currently trading for about $365 a share. When we jump over to their dividend profile, the dividend yield, really low, 0.9%. Dividend payment per year is $3.36. Payout ratio, really healthy, 27%. Growing it at a very modest rate of 8.7%, and they've been growing their dividend for the past 15 years. When we take a look at their dividend payment growth visually, it's going from 80 cents every 3 months to 84 cents every 3 months. I think Stryker is a good company with a good future. They're overvalued currently, but the thing is, I would prefer the medical device business model over the pharmaceutical one any day of the week, except maybe Taco Tuesdays. Then I might consider the pharma industry, but who am I kidding? I would not buy into pharmaceutical stocks ever. But jokes aside, I think the medical device industry it's not bad. The next dividend grower is gonna be the last one, and that's WP Carey, ticker symbol WPC. They're basically a commercial REIT. And they're currently trading for about $53 a share. Their dividend yield is 6.5%, meaning for every share of WP Carey that you own, you get $3.52 a year in dividends. Their AFFO to dividend payment ratio is 75%, which means it's healthy, it's sustainable, and they grow their dividend at a rate of 2.3% year over year. However, when we look at their dividend history, during the Great Recession, look at what happened. WP Carey were paying 18 cents every 3 months, but during the recession, they cut their dividend. This is not good. When I know that a company has it in their DNA and history to cut a dividend, it makes me hesitate. It makes me want to take a break, drink some water, and just evaluate my situation, like, why am I considering this company right now? And not only that, their AFFO growth has shrunk by 7.9% year over year. When it comes to REITs, you want to think of the AFFO, the adjusted funds from operations, kind of like the free cash flow for a normal company. So thinking about all of that, I think WP Carey is undervalued, and some people might say that it's a good alternative to Realty Income Corporation, their peer and rival, but the fact that WP Carey cut their dividend about like 15 years ago or so, I just can't think of investing into this company. And if you thought the video was over, well, you're mistaken, because now it's time for some words of wisdom. Think about yourself on a ship. Here's the thing, you can't control the weather or the wind, but you can always adjust your sails. It's out of your reach and control on what the weather wants to do. However, you can make adjustments and drive the ship in a different way in accordance to the weather, the wind, and whatever. All that to say, life is fun in that it's never predictable. Life can be good sometimes, and other times, it throws dog poop onto your front yard. But regardless of what happens, you can always choose how you respond to life. You can freak out and unleash your anger on your family, or you can choose to adapt, change directions, or even enjoy a nice turd brownie. I mean, I don't know about you, but I heard dog poop tastes pretty good. Or at least that's what my puppy used to say. So whatever happens, don't waste your energy on worrying about things that are out of your control. And I say that because right now, the market is selling off because there's a lot of fear in the streets. Investors are kind of hesitant. And big money would rather sell out of their positions than just hold cash. And so if your portfolio looks anything like mine, seeing the red is not a good feeling. But if you're invested into high-quality compounders that pay a dividend, with due time, they should rebound. Not always, but for the most part, these high-quality companies, they usually make a comeback and then reach a new high. It just takes time. So stay positive. And on the other hand, if you're invested into speculative, unprofitable businesses, then I guess this storm can be a learning lesson for you to join the dividend growth investing team. We're always accepting new players and no experience is necessary. But jokes aside, no matter how big a storm is, it's going to eventually pass. And the thing is, how you navigate through the rough sea makes all the difference. So as you can see on your screen right now, focus on what you can control. You can't control whether a stock is going to go up or down. But what you can control is your emotional regulation, your patience, and reminding yourself of your investing thesis of why you bought into it, why you believe in the company. And as the market dances around, goes up and down, you can collect a tax from your positions in the form of a dividend. They pay rent to you for being a part of your portfolio. Anyways, if you're not sold on the idea of dividends, I don't know what else to tell you. So what do you all think? Do you like any of these companies that we talked about here today? There's 20 of them. Do you hate any of them? Maybe you're a racist. Maybe you're balding. Maybe you put your entire network into one of these companies. Let me know how you feel. And if there's enough interest, I can absolutely do a deep dive on one of the companies if that comment gets enough likes. And truth be told, my nipples are kind of small, but none of these companies are on my buying list. I'm not buying into any of them. If you want to know which companies I have been buying for the past few weeks, then go ahead and watch the video that I made talking about just that. And with that said, I love you guys, stay safe, and I'll talk to you really soon. Peace.